So as always, the thing that really matters is your plan. So you might have heard me say this before. In investing, our hero is prices. Something that makes us different than 99% of media talk and what people are talking about all the time on the internet or newspaper and money magazine. We don't think things are mispriced. We're not trying to buy something that's mispriced, hoping that it gets priced correctly later. We think markets give us all the information we need, all the information that's real. So prices reflect all the current data and the aggregate future expectations of all the market participants. So what that is, we said earlier, there's 9 billion trades a day that are $408 billion of value traded every single day. So trying to find, how many people are trading Microsoft every day? Hundreds of thousands of people are trading Microsoft every day. So we're pretty sure that all those people trading drive the price to roughly the right place. So the price it is today is probably the best representation of reality. So fairly priced securities can have different expected returns. So there's a ton of academic research on this, and we're going to talk about the 3 or 4 most widely accepted academic understandings of where we get expected returns. This is our process. So our goal when we're investing is to efficiently capture these higher expected returns using the information that's contained in the current price. We're not guessing what Apple's new thing is going to be. We're not guessing whether Tesla is going to fail because it can't raise the next funds. We're not guessing that. We're looking at the price. We take the price as price is our hero. We believe in the current price. Okay. And the reason is because all the history says that if you try to guess what happens next, if that's the goal, no one succeeds. And we're given statistics like 30% of managers can beat their index. 30%, that's the statistic we're given. But what's missing in that is 30% of managers that survive, right? Only half of managers survive. So this is, in the beginning of the period 2003 to 2017, there were 2,828 portfolio managers. 51% survived, 30% of the total, roughly, beat this number, but 14% in the equity world beat that. And these are the people that are trying to figure out what's mispriced. Every day they wake up and they say, gosh, do we like Chevy or do we like Ford? Or do we like Apple or do we like Samsung? What do we like? What do we want to buy? And we're making a decision based on that. They cannot win. This proves it. But one step further. Those people that are successful in one window of time, in the next window of time, are equally likely to be less successful, be at the bottom. Right? So only 26% of these funds that were in the top 25% stay in the top 25%. So that's it's almost like perfectly efficient. It's almost a perfect bell curve, right? Except in fixed income, there's a little bit more success. So you cannot rely on any manager's past performance as an indicator of their future results. We know this, right? Why is it that 95% of media talks about this is mispriced, or we should buy this, or we should sell this? You can't win in that game. So what can you do? There are 4 academically supported, and by the way, there's probably 300 that have been studied. And there are 4, and I'll talk about a 5th, that academics think works until they try to apply it. It's too expensive to apply. So the first is stock markets outperform bond markets over long periods of time, right? There's an equity risk premium. That means if you deal with the volatility in stocks, you will get a higher return long term. This year, you may lose a bunch of money. Long term, you'll get a higher return. Small companies outperform large companies. Over long periods of time, that happens. In the last 4 or 5 years, didn't happen. What does that mean? That means the last 4 or 5 years were outside the norm. The next 30 years, it's going to happen. Relative price. If you pay less per unit of earnings you have less downside, you have more upside. That works out long periods of time. Again, we saw that chart earlier that the last 3 years, value has been beaten by growth. So that's 2 of our 3 tilts that haven't worked the last 3 to 5 years. Profitability. This is the most universally accepted. Profitable companies outperform less profitable companies. That should make sense. Weirdly, this is the last of the ones that they discovered. Academics. The 5th is momentum. You hear a lot about momentum trading. And momentum works until you try to trade on it. Because every time you trade in momentum, you create a tax consequence, you create a commission or a transaction cost. And so the minute you factor in transaction costs and tax consequences, momentum loses its value. But if you're going to invest based on these 4, then you can use momentum in a buy-sell decision if you're going to buy-sell anyways. So that's how, when we use that, that's how we use momentum. Okay. There's a lot of noise here. There's 3 charts. We're going to go this one, the next one, the next one. This is 1-year premiums. Notice that this red is when that particular premium didn't work. This is the market premium. So this is the blue on the top is when the market outperforms fixed income. This is the small versus large. The blue on the top is when the small companies outperform large companies. This is value minus growth. Value outperforms. And then down here is high profitability minus low profitability. This is 1 year. You see how many years it doesn't work. Okay? Lots of times it doesn't work. And I'll put a percentage on it in a second. This is 5 years. Okay, this is 10 years. So 2 things I'll notice here. The vast majority of time, you want to be invested in this way. This is value. This is 10-year rolling. So for the last 4, 5, 6 years, value has been underperforming on a 10-year rolling basis. That's our number 1 drag right there. We see it, we know it. So the question is, I'm going to go back here. The question is value broken? So this is what it means to be a dimension of returns, to be one of these factors. It has to kind of make sense. Does it make sense that a smaller company would outperform a large company over a long period of time? Does that kind of make sense? Large companies are already everywhere. They don't have new markets to enter. They've already developed all their products. A smaller company can develop a new product. It can enter a new market. Huge upside, right? Makes sense. Does it make sense that buying more units of earnings for a lower price, does that make sense? That would work? Yeah, makes sense. So this is pervasive across markets. Persistent across time. Going back to the beginning of every index. Across markets, looking across every geography. Robust to alternative measures. Is it price to book? Or is it price to earnings? Or is it price to cash flow? What's the best measure that incorporates the most information? In value, it's price to book. That's what it comes out to. And then is it cost effective? That's why momentum doesn't work. It's not cost effective. Okay? I want to look at the inverse of these probabilities. So I'm going to look at value versus value beats growth. So in a 1-year period, 61% of the time, value beats growth. What does that mean? That means 39% of the time, value fails to beat growth. And still, if you invest that way, 85% of the time in a 10-year period, you're going to end up ahead. That's a probability that I'm willing to take, right? The other things, we can go back and show the 14% and the, 17%, 18%? The managers trying to pick stocks and trying to figure out what's happening next by, markets mispricing. They obviously don't work. This is the best it gets, is the factors of performance that we know work. And that's the market, that's value, that's small beating large, it's high profitability. So what does it add long periods of time? So this is US, developed ex-US, emerging markets. This is company size, relative price, profitability. So this is not the add that we expect in our portfolios. This is the difference between top decile and bottom decile. So we're not just buying the top decile. We own everything. We believe in diversification first. Okay? So we expect to get some of this and some of this. as an additive. But we believe in diversification first. So we own everything and we tilt in these directions. So that's philosophy in a nutshell. Does anyone have any questions about that? Have I just completely lost everybody? Fried the brains? So I guess the question, this is the method I am committed to. I know this works. This is how my money's invested. Mom, Dad, this is how your money's invested. This is how my children's money's invested. Because I know that over long periods of time, this works. And Q4 of last year didn't work. Sometimes that's what happens. The issue that people face, and I'm glad you're here because you get to hear this, the issue people face is they start idolizing the S&P or FANG stocks, and they think that's the way it's supposed to be. And that's just, people are fraught with peril doing that. Eventually that you lose a whole bunch that way. Okay, so these are all the times when the value premium did not exist. These are 10-year rolling periods where value lost to growth. I've actually typed them out here. They are 37, 38, 39, 40, 98, 99, and then 11, 12, 13, 14, 15, 16, 17. So the two major times historically that value has not outperformed growth have ended horribly for the markets. I don't know what happens to FANG stocks. I can't predict that. But I'm committed to the value. I think that's the way to go. And I think that's it. Yeah, that's it. Okay. Thank you very much. I'm here to ask questions.